Good turnaround Tuesday, Warriors. Let's have a great day. Hello, everyone. Let's take a look around. So what I was talking about yesterday was EG, okay? When I couldn't hear you guys. So I was showing that we negated, or we ran the throw over around yesterday's opening of this wedge that did not negate and continued to diverge. And we have a breakout here. I'm doing pretty good, came in short pound, long euro pound. So trading wise, okay. Life wise, okay. Okay. So, I was going to come in on Good Friday, everyone. Just to put things in perspective. Hi, Paul. Is that a Good Friday 5 or 6 years ago? I don't even remember. Yeah, I went in for a colonoscopy, and when I woke up, the doctor and my wife were looking at me with those eyes, and I was diagnosed with cancer that day. I think I had 3 tumors. And just want to keep everything in perspective that being stopped out of a trade is nothing compared to almost being stopped out of life. And I know we see a lot of that around us with what's happening in COVID. So keep your trading in perspective. I'm not saying it's not important, just don't make it too important. Do you know what I mean? Give me a why if you understand that pips come and go and time is gone forever. Time is gone forever. So, make it count. And you don't want to make it count being in a fetal position and feeling sorry for yourself because of what's happening in your trading account. They're just trades. Okay. All right. So I'm having some trouble with TradingView. I'm getting the right charts, but not getting the right quotes. But took a shot at the pound last night over 39, and we're at some pretty important support. But I think this is a turn when you look at EG. We're taking out stops now. After this, no one was long anymore, especially after the huge decline we've had from 92. There were no sell stops left. If this was a sell stop, it took it out, and then probably had people that were trading the wedge freaked out on a throw over or a throw under, depending upon what you want to call it, label it. So how do you trade throw overs and throw unders? You just wait for one candle to close back inside the formation, and then you risk the low, the move of the throw under. So I think we're on the verge of having a 2-week reversal. There's your weekly. And, I'm thinking that there could be a pretty good rally, maybe back to here, 87. I mean, you go just round numbers, 92 to 85 is 7. So why not 38% back, be 280, takes it up to about 87, 80, right up here, right around here, 87, 80, right around 88. I think that's a possibility. So there's your daily. Let's look at the weekly. And you'll see, I know it's only Tuesday, but we have the beginnings of a possible outside week to the upside. We need closes by Friday. When you're doing a weekly reversal, you don't know till Friday, right? So if by Friday we're trading back over 85.48, which we're only 10 pips underneath, you're going to have a 2-week reversal. So, this was really the big breakdown up here under these lows. Why can't we rally back to the breakdown? Just something to keep in mind. S&Ps, we're still, except for weekly, we still have some divergence. Daily, still have some, but you go to some of the other TFs and look, you have confirmed highs on 4 and 2. I think Blake tweeted that we got to one of the fib extensions yesterday around 40.70 something. We're right around here. And then I think from talking to Steve Volge a week or so ago when he was showing fib extensions, he had some confluence of some fib extensions up around 41.40, if my memory serves me correctly. We're going to have a guest on here today that in at least 5 years ago, maybe 6, talked about the S&Ps going to 4,200. You know, now we're within a stone's throw away from it. So where were we in 2016? I guess I have to pull up a monthly. And, you know, back then, I thought it was such an aggressive target because a lot of the Elliott Wave guys were only talking about 3,200, which, you know, this 3,200 ended up coming into play. But all the way back in here, we were probably around 2,000 in the S&Ps. Peter Goodburn had a 4,200 target for the end of the bull market. I know that's changed, but what a call from back then, a doubling of the S&P. So stick around for an update on what Peter's thinking today for our interview. And I want to just show one more thing. And I'm not sure if that's going to be enough, but look at what Canada did yesterday. Look at this. Right to the 50% level. Nice pop, right? About 70 pips or so. Are we going to break out here? We have one more decline. I thought we might get to 61.8, but you know, the smaller the retrace, the more bullish a market is. So if that's all we're going to get is 50%, that's a pretty strong market. So keep an eye on Canada because, you know I talked about it last week, was that oil, which is the opposite of how it's been for a while, has, started showing dramatic relative weakness. Let's see where we are. I mean, yesterday was down $3. Looks like it fought its way back. I remember saying to Blake, it's gonna be interesting to see where WTI is at when the S&Ps are at the highs. So, risk on has not been helping energy at all. So even if we rally another, 100 handles in S&Ps, we'll see what crude could do. I think it's given us a signal that there might be, some problems globally, economically. The Chinese are pulling their horns in from some QE here. They're worried about the bubbles they've created. So the Chinese market is way underperforming what has been happening in the US and Europe. So, you can't have it two ways. I remember back in 2008 when we had the housing crisis that, it didn't hurt, the Great Recession did not hurt China as much as it hurt us. In fact, they kept growing. And the narrative back then was that China's resilience will help pull us out of the Great Recession. It wasn't called a Great Recession then. It was just, a housing crash and a derivative panic. So if China is heading south, you can't have it two ways. If they're weakening while we're still doing okay, can't they drag us down if they could pick us up? So something to keep an eye on, and maybe that's what the poor performance of Aussie is telling us, besides frictions, trade frictions, and everything else between Australia and China. So what's on the docket for you, partner? Well, not partner, associate, captain, CEO of ForexAnalytix, Blake Morrow.
Hey, Dale, how's it going?
All right.
Wait. Is he talking? Are you talking to me?
Yeah.
What's happening?
No, finally, cable's given up some ground to Euro. It's been a long time.
Yeah. And actually, the cable, this is analysis from this morning, about an hour ago, cable may find some support at the triangle breakout point here at 138.25, but a break of the 138 level would lead us to a complete breakdown. And but right here we are at support. This is that triangle that you can see here. This is right where we should bounce here, and we have. I mean, it's
what's the harmonic that it completed? Was that a Gartley?
That is a Gartley. Yeah.
Okay.
That's a Gartley.
Dennis Gartley? Oh, I mean Dennis Gartman?
Yes, Dennis Gartman. Exactly. That's exactly who that is.
He's short. Ever listen to him? He always says, "I'm long of," or "I'm short of."
Yeah, I'm long sterling gold terms.
Yeah.
Huh?
Oh, yeah. Yeah. He makes it so people really don't understand what kind of position.
No, I think he's retired, but
well, it's the commodity king.
Huh?
On CNBC, they called him the commodity king. That was his nickname, like mine.
He was if you ever read the Gartman letter, it was the best fading letter to read out there.
They
so
do that on Twitter
great.
all the time.
Yeah, I mean, yeah. So I mean, he retired. I guess the last 2 years ago, maybe. I don't know, something like that.
Have you ever been to a retirement dinner for a trader?
No.
Yes. Do you know why? They don't exist. No gold watch in this business, guys. If you're looking for one, do something else.
That's true. That's a good point. Good point. Yeah. All right, let's I wanted to cover a few things. First of all, equities continue to rally, and you pointed out that we're at the 161% extension, but we have this is the one we were talking about yesterday. We're right there at 40.75, but if you just look up a little bit further, the next 161% extension, now that's of this this move here from February to March, that comes in at 4,100, and that is the megaphone top. So can we reach for these levels? Absolutely, we can. And you can see it's North America's here, so don't you worry. If you guys are in Europe, never fear. North American traders are here to buy up everything. So Congratulations, you guys made it this far. Whenever you're in Europe and you think that things look dire, just wait for a few hours till North American traders get here. They are going to scoop up everything and buy everything. So that has happened this morning, and you can see as soon as the North American traders sat down at their desks, markets started grinding higher. You can see it in the NASDAQ start pushing higher, and then and the Dow it's kind of lacking a little bit, but it's getting there. So anyway, equities are bouncing back. I'd expect that they would bounce back, at least initially. It is turnaround Tuesday, so there's something that's really, really important that's happening right now that I thought I'd bring up, and I don't always bring up this information, Dale.
Yeah.
But volatility DSI is at, I want to say it was at 9.
Okay.
Let me double check that number. I'm going to pull it up for you. Daily sentiment index. Oh yeah, here it is. Oops. Overnight 9 on volatility. S&P is at 90. You know what that means?
Wow. Yeah.
That means things are really dangerously extreme right now. So when you have volatility, and you have to think about volatility actually bounced a little bit yesterday. When you have volatility at 9 and it's a single digits, we are extreme bearishness for volatility. So the risk is, in my opinion, that we start trading higher. Remember, from last week, we actually filled the gap. This is the gap from COVID lockdown gap. We finally filled that gap last week, and my opinion is volatility is ready to rally. And with daily sentiment as low as it is, it's definitely, I'm going to say there's a really, really high probability that it's going to bounce. So when it bounces, there's a good chance that S&Ps come down, and the NASDAQ, and the Dow. again, we are the where we're at right now for volatility, purposes. Or excuse me, with DSI purposes, we're at 90 in the S&P. That is very extreme. Nasdaq is not quite there, but Nasdaq's at 85. And those are just really high readings. So I wouldn't be surprised if we see a reversal today. But what I'd like to see is some of these commodity currencies turn. And the Aussie dollar specifically, I was looking for a move to 77 cents to get short. The RBA met, nothing exciting happened there as anticipated. We held resistance and we've rolled over a little bit. I want to see the Kiwi dollar start to move lower. We almost got to the 71 cent level, but in all actuality, if you look at this last move, we've only rallied back to the 38% retracement. That's shallow, right, Dale?
Yeah,
it's a shallow retracement.
The smaller the retracement, the greater the inherent strength of the move.
Yeah, exactly. That's a great way to explain that. Sorry, I was just getting a drink of my my coffee. And then you look at the dollar Canadian. The dollar Canadian is trying to build a longer term inverted head and shoulder pattern. We held the dip to 125. We bounced pretty aggressively. But if
that was halfway back there, Blake.
What's that?
On my fibs. Yesterday's low in Canada was halfway back.
Yeah, it's a 50% retracement at 125.07. Now that's what we've had as support, and it's held as support. One of the and then also one of the other currencies that I think we should be paying attention to is the US dollar, Norwegian krona. We are holding that base and we're trying to break back above this trend line. These are currencies, these commodity currencies are the ones that, in my opinion, are going to suggest if we're going to, turn a little lower today. And remember, with DSIs where they're at with volatility and with the S&P, I would not be surprised if that happens today. But, we might actually have to wait for tomorrow because the market it's bullish. And that's a fact, right, Dale? I mean,
yeah.
It's hard to. I was talking to some of the traders in our chat room yesterday, and I'm like, man, it's hard to fight this tape. And I know where DSIs are at. I know where, where the extremes are, and I know where the levels are. But it's hard to, get out there and say, all right, I'm going to short here.
Well, Blake, I recall your words about the S&Ps is that we needed to see some type of blow-off action before the top. And if that's not what we're getting the last couple of weeks, if this isn't blow-off action, someone on CNBC started to describe the S&P chart like the Space Needle in Seattle. Even some of the bulls are starting to turn a little negative here, but this is definitely blow off stuff here.
Blow off tops to me and or capitulation type of moves are when you start to see the just exaggerated moves higher. I don't know if this is a capitulation type of blow off top, but I mean,
maybe not yet.
Let's see that. I mean, we've blown out probably one of the bigger shorts in the market, and I'm assuming that was Archegos, right? And they've lost. How much money have they lost? Stelios, I think he's probably keeping track of all these numbers.
Was it 110 billion? Something like that?
Is that it?
And they were using 500% leverage.
I mean,
nice.
Dude, that's a blowout everybody short type of move. I mean, is that the top? I mean,
okay, so they were short. He was in derivatives and stuff.
I'm assuming the positions were short because we are seeing the squeezes that we're seeing in the S&P are on Fridays at the end of the day.
Okay.
You know what I mean? So that would be my assumption, but I don't know what they're both.
Well, when we finally do get the correction, and if you recall, I said, some of my sources were saying 4,100. a few weeks ago, and we do get a correction, and the tide goes out, we're going to see a lot more of those.
Yeah.
Because
Oh,
of
yeah.
because of high leverage on either side of the market.
But I'm gonna say I'm really not willing to stand in front of it right now. All I can do, if I feel, which I do, I feel that we're probably going to be topping somewhere around here. I'm not shorting the S&P. Why? Why would I do that? I'm actually, you know, short commodity currencies because they're the perfect hedge for this. You know, that's why I've got some long dollar Canadian exposure. That's why I've been building a long US dollar Norwegian krona, you know, down here at the 850 level, because if stocks actually turn lower, these are going to be the first ones that go.
Yeah.
So that's, and let's flip that around for a second. Let's imagine you're sitting here watching the stock market go higher, and you're like, I'm getting long the Aussie dollar. You, at this point in time, you probably want to shoot yourself in the head. Think about that.
Don't do that.
But let's think
Don't shoot
about that
yourself in the
correlation.
head.
I'm long. This is where the FX differs from stocks. Because if you know, some of you might be going, but Blake, you've been saying that the stock market may peak, you know, for a while, you know, as we're up here around 4,000, and you know, we keep hitting this, you know, this resistance, and yeah, every time it goes higher, and the Aussie doesn't go higher with it, that's just one more nail in the coffin in the Aussie dollar. So for me, and again, think about that. If you trade predominantly FX like I do, S&P goes higher, and you're like, that's it, I'm buying the Aussie dollar because it should be going up when stocks go up. You are probably the most frustrated trader out there right now, I would think, because you're buying the Aussie dollar and it moved up two to 10 pips for you as the S&P just surged 80 handles. So, you know, that's why I've got my focus right now on, you know, short some of these commodity currencies, because they're not moving up with stocks. And so if stocks come down, they're going to aggressively move down. So anyway, I hope that made sense. Stelios, how's it going, man?
I'm very well, thank you. And I wanted to say, from the moment you said earlier about the Kiwi, the retracements higher are quite shallow. And I was going to say, look, it's exactly the opposite with the S&P. The retracements lower are shallow. So
yeah, you're exactly right. It's a push, right?
One of the two is wrong. Which one is wrong?
And that's what
a question.
Steve pointed out yesterday.
Yeah.
Right.
So I agree, and that's what I feel really weird, because, you know, commodity currencies, especially the Norwegian krona, I really like for years now, and it's done really well post COVID, and now I find myself thinking I cannot be long the kroner, so basically I can't be short Euro Norway and dollar Norway that I always was, and in fact I'm looking for opportunities to go the other way for the short term, and it's really weird for me because it feels like a sin for me. It's like me shorting silver. But anyway, I think there is a possibility now, these commodity currencies, if there's any whiff of risk off, man, I think they're going to be in deep trouble.
Yeah, especially, you know, the narrative right now is, oh, we're going to have massive inflation. Again, it doesn't mean it's your narrative or my narrative. It's just, that's the market saying, you know, this time's different. It's always this time's different, right? So this time's different. We're going to get this massive flux of inflation, even though all the central bankers tell us there's no inflation coming. Doesn't matter. We're still going to get inflation. Let's buy commodities. Yeah. Let's buy Aussie dollars. Let's buy Kiwi dollars. Let's buy Canadian, Norway, whatever. And they're just not moving. So
there is a slight piece of, sorry to interrupt, a slight piece of truth in the saying this time is different. It's slightly different because as the years go by, central bankers do everything they can. They put everything into it to avoid recessions and avoid the equity markets going down. So in that respect, they're putting a lot of effort and a lot of money into it. Yeah, QE and zero rates, and they're going to do more and more. We know that.
Plus, we do have massive influx of inflation. The only question, because inflation is the expansion of money supply, and we do have that. So the question is, if this time it's going to spill over to consumer prices and show up to the anyhow toyed CPI, and the answer is most probably yes. Because what's different this time is that a lot of the money injected in the economy are not injected at the top, but through what is in essence a stealth universal basic income that started with extended unemployment benefits and in essence giving people the incentive not to work because it's more profitable than to work, plus a lot of supply disruptions, plus a lot of less people participating in the productive activities. So more money to buy less products. I think these are the main and substantial differences we have in this occasion in opposite to what we had in the past.
Yeah.
All right. Well, hey, Steve, I wasn't sure if you're going to be here today. Happy birthday to your son.
I would tell you if I
is it today? Is it Jason's birthday today?
Yes.
Oh, happy birthday, man. I forgot.
Thank you.
Well, is he 5?
He's 5, yes.
Wow.
That's
amazing. He is 5. Yeah.
I was
time flies by, huh?
Just yesterday, I was playing. We were playing pickleball with the group of guys that I play pickleball with, and one of the guys brought his son that I hadn't seen in 5 years, actually, since I coached him playing soccer years back, and I couldn't even recognize his face.
Yeah,
it's wild.
They grow up so much, huh?
Yeah, he's 14. I was like, wow, I didn't even know it was the same kid. Anyway, what? Yeah. Capture it and smell the roses while you can. So happy birthday to Jason. I know we have an interview coming up here shortly, Dale, but Steve, what's on your radar today? What are you looking at right now? With knowing that we're the stocks, I mean, the S&P is well above 4,000. We've got the S&P challenging the 4075 level, 161% extension that we knew we were going to reach yesterday, and we're just kind of holding around there. Any thoughts today before Dale takes over?
Listen, I got burned many times early in my quote unquote career in trading by trying to fade prevailing trends based on logic and fundamentals. And after doing the same mistake multiple times, I think I more or less stopped doing it, meaning I find no reason why I would want to fade equity strength, not until we see some type of a big reversal, and they have a big upside target at 41.48, so we're not there yet. And as long as that's the case, as I was saying yesterday, I find no reason why I should be forcing myself to try to be bullish the dollar, because I don't think that both of the things can be moving in the same direction at the same time. Dollar higher, equities higher. I mean, they can, as proved during the past few weeks, but in the case of the dollar, it's like a very weak rebound so far. So until or unless we see some type of a big reversal and some cause to believe that it's going to last for more than a couple of days in equities, I don't find any reason why I should quit my short USD NOK position, or why I should be long any type of dollar pairs. And I do think the chances are higher for a continuation higher in the Aussie, the cable, those two especially. I do like the formations they've been producing, even in the Euro potentially. Admittedly, the Kiwi looks more bearish than the rest. So obviously, if I was looking for dollar strength, I wouldn't be looking, to be buying the Kiwi. I mean, there are better opportunities out there, clearly. Now, on the other hand, as I've said, that doesn't mean that I would advise anybody to buy stocks at current levels. It's madness, right? It's stupidity. So I think that people should remain patient. I know how hard it can be, especially when it's a prolonged thing, as it's in this case. But between forcing yourself to follow the FOMO or staying sidelined until there is actual opportunities to do something, I'd rather do the latter.
Yeah, and I mean, this is not the market where you want to force trades. I'll give you an example yesterday, just so you guys know. And what the hell is going on here? You know, it's interesting. My quotes aren't working right here on the right hand side of TradingView, but it doesn't matter.
The charts are good, but the quotes aren't on.
Yeah, I noticed that actually yesterday.
No, they do. I see it, Blake. I see them blinking.
Yeah,
but they're wrong
on this particular feed.
Just refresh the page.
Refresh the page, Blake.
Oh, okay.
The page itself.
Okay, will do. I'll do it. But the one thing I want to point out, like this is a case in point, Steve. And let me just grab my. Oh, I guess it did work. Okay, great. Thank you. So I have an order, and it's actually still out there, to sell the euro dollar at 118.30. I had it out all night. You know, today's high, it was 118.22. I got up this morning, wasn't triggered. But guess what? I'm leaving it out there. I mean, if it triggers, I know why I want to be short. I want to be short. This is previous support, current resistance. It's the flag top. That's why I want to be short the euro right there. But I'm not going to just go ahead and start shorting it here. And I was thinking this earlier this morning at 118.08, because there's a big difference between being short at 118.30 and 118.08. It's 22 pips. And 22 pips in this market could actually mean something, because if you're not patient and you're just chasing things around, you're going to run into problems. You're going to end, when you're in a market that you have to actually wait for price to reach a level, and that means you have to let prices come to you. And in days like today, or in markets like what we're dealing with right now, it's super important that you do that and you practice that. All right. And now I know, Dale, you got your meeting, or your interview.
That's okay. I look forward to meeting Peter one day.
That's right. Peter's always a great guest. I just want to mention that, guys, if you haven't, whoops, that's not where I wanted to go. If you haven't visited our webinar sponsors, you want to try to get ForexAnalytix for free, open your account with Pepperstone Securities. You have to click this link right here where it says open account in ForexAnalytix sponsored. Right here, you click here and it actually links your new account to ForexAnalytix. You can get up to 4 months for free. And then below that, if you live in the US and Canada, make sure you visit Forest Park FX. They are like the concierge of brokers. They're going to just find you a broker that can give you cash back rebates, can help you find a broker that's best suited for your needs, because we all have different needs as we trade. Yeah. So make sure you visit our ForexAnalytix sponsors, because we can't.
And let me make it very, very clear, because I'm part of this program. There is only upside, honestly. I mean, they say there is no such a thing as a free meal. In this case, there is, because in essence, what you do is you get part of the commissions that your broker gets from you back to you. So it's money that you give away otherwise.
Yeah, there you go. All right. Well, thanks, Steve. Thanks, Stelios and Dale.
Thank you, Blake.
Have a great interview with Peter, and thanks everybody for tuning in and spending your time with us. We really appreciate it. And by the way, if you're watching us on YouTube, make sure you click the like button, subscribe to our channel, and give us some comments down there. I'll be in there to respond. All right. Thanks.
All right. Good hunting today, Blake. Welcome back to Face, my trading warrior brother, Peter Goodburn. How are you, buddy?
Great. Dale, can you hear me okay?
Yeah, loud and clear, Peter.
Perfect.
Welcome back. You want to share your screen? It's that green box.
Hey, Peter.
Yes. Hello, Steve. How are you doing?
Good. How have you been?
Yeah, pretty good. Thanks. Yeah. Despite lockdowns and things.
I hope healthy and everything all right, huh?
Yeah, everything's fine, thanks. Yeah, I mean, it's it's quite extraordinary, really, what's going on with this lockdown business, isn't it?
It
just goes on and on.
What a way for Merkel to go out after an outstanding career as the leader of Germany for this to.
I can tell you one thing in advance, Dale.
What?
As it happened with Thatcher, not that I'm comparing the two of them having to do with policies, right?
Yeah.
But people are really going to miss Merkel. You know,
Yeah.
a lot of people in Germany, and I know that because I have close ties with, you know, a lot of people that live there. And
Well, Peter lives there.
I know.
Oh, okay.
A lot of people are like, you know, criticizing Merkel for, you know, several things, but I can tell you in advance, seeing how the how politics worldwide are moving and how the quality of politicians is evolving over the years, I can confidently tell you that people are going to miss Merkel.
Okay. All right. Well, you know, I'm going to send you a poster of her to hang up in your trading for times that you miss her. So anyway, Peter, Peter, anyway, you know, how long have we been having these conversations, you and I? I'm guessing 6 years.
Quite a few years now. Yeah, that's
6 years. So, you know what? I want to talk about something that happened early on when I first started talking to you back then. And what stood out for me with you is that you had them, in my mind, almost like a crazy aggressive target in the S&Ps of 4,200. And this was like 2016, 2015, when we're in the 2000s.
Yeah.
And here we are, knocking on the door of that number. I know back then you thought that might be the completion of a generational bull market. I know things have changed. You know, things change day to day, let alone, you know, 6 years ago. But 4,200 was your number. Congratulations on that call. You were the most aggressive, had the most bullish, aggressive wave count of anyone that I had interviewed during that time frame. And here we are manifesting it.
Yeah, thanks,
it.
Dale. That was...
I think Dale, Peter has what you like to say. He works with a telescope.
Yeah,
right.
He does, and
not with a
microscope.
microscope.
More like.
Yeah. So 4,200 resonating in the market. Even saw that number bandied about on CNBC yesterday. Peter, Tom Lee, who gets a lot of coverage, that's his call for a high of around 4,200 in April. Check it out and see if he's a subscriber.
Tom Lee. Okay.
He's been with a few different companies, but he's frequently interviewed and kind of a fund manager, I believe. But he said 4,200 in April, and I said Peter said that in 2016, 2015. So you want to start with the S&Ps? Here we are. Okay.
Well, I thought, I think it would be good to revisit maybe that long-term count. I originally had 4,200, but I've upped it this year to 54.
Wow. By 2023. Okay.
Yeah, I think we've still got that 94-year cycle running, which is well, actually, let's have a look at the long-term Dow charts, because when we first started to talk about the Dow going to 40 to 42,000, anywhere there was a band of range between 39 something and 42 something. It was back in towards the end of 2015, and that's because we reached our upside objectives at the time, but we didn't see any commodities reach our upside objectives. So we realized that the entire movement up from the financial crisis lows was still running up as an expanding impulse pattern.
What does Shemitah mean? I saw that word on your
Shemitah.
Yeah.
Oh God! I mean, I did some analysis. Yeah, I did some analysis some way back because I read a book while I was on holiday. It was called oh God!
Based on Hebrew?
Yes.
Okay, like the Torah code?
That's right. And
oh wow! Okay.
And I started to get really interested in reading this book. And anyway, it was talking about cycles and stuff. So I came back and started to look at what the Shemitah was and how that really sort of played in. So you just saw that in one of my charts.
You curious cat, you.
Well, another time we can talk about that in more length. It was quite
Okay.
extremely interesting, and actually I'm fairly interested in knowing what's going on with that now, because the rabbi that talked about this and wrote this book, I'm sorry I can't remember it offhand. It might come to me in a moment, but anyway.
Yeah, I think it was Cohn or something.
Yeah, Cohen.
Yeah. Well, you could say Cohn, and that'd be a pretty good guess for
yeah,
for a rabbi.
that's my pronunciation. But
Yeah.
Coming back to the original idea of 42,000 Dow was this number was basically derived from this sequence here. It was the fact that we had a fifth wave extension from 1974 coming in. This was subdividing into 5 waves, and I simply found 2 fabulous fib price ratios which were converging. And I use fib price ratios in a quite dynamic way, probably not unlike anybody else is using, but over test of time it really works. And what I did was I extended waves 1 to 4 because wave 5 was going to be an extended wave. You can actually extend waves 1 to 4 by 1/618. Now you can't use that ratio for anything else. So they're quite specific according to the pattern you're expecting. But if I just double click, you'll see this projection coming up.
Yeah.
So that's how we got to 41,000. And then it was just a simple case of trying to find a fib price ratio convergence by taking the 5-wave advance in the Dow. And I think what I did was I took a 61.8 correlation ratio like this. Yeah. So I took 1 to 3 multiplied by 61.8, add to 4.
Mm-hmm.
And you go like that. And can you see the top? If I toggle it a little bit, can you see the top?
Yes, got it.
And it's crossing the same number.
Triple fib price ratio convergence.
Yep.
Okay.
So that was how that was derived. Anyway, just a bit of background from that long-term range forecast that goes back 5 or 6 years. Anyway, the more subject, I mean, I know we're pressed for time, but I just thought I would kick off with what we're talking about, the S&P, because it's been quite an extraordinary run. And I have to say that in terms of my expectations, that is what we've experienced since March last year. It's done more than I thought, because in this first phase, even though we've got upside targets going higher, because generally speaking, when you get a major collapse like this going last year, normally if you're experiencing, now we've labeled this as a 4th wave low and a 5th wave up to our targets. Now, normally, if you're going to subdivide that, the normal procedure for an Elliott wave analyst would be to start extrapolating into an expanding 5-wave impulse pattern. By that, folks, I mean, a standard principle of expanding 5 waves, where the 3rd wave is generally the longest. This is the template. Right. Now, of course, you get variations to the theme. You can have 1st wave extensions and you can have 5th wave extensions, but around 85% of the time, you're going to see a 3rd wave extension. And if you're going to extrapolate such a pattern as the beginning of a 5th wave, it will take on this pretty much 85% of the time, it will take upon this pattern where the 3rd wave extends. And generally speaking, it would probably get close to reattempting a previous high like this, and it would find probably formidable resistance. Sometimes it breaks above slightly like this would. Yeah. And then you get a fairly sizable correction. We never saw that.
No, never happened.
No, and that's quite remarkable. Now, I think I know the reason why, because I mean, it's taken a little while for the penny to drop, but back in February, the penny did eventually drop. Because I started to look at the Russell and a few other US indices, and suddenly saw that this upswing, rather than being a 5-wave expanding impulse pattern, rather than having a 3rd wave extension or maybe even a 1st or a 5th, this was developing into a zigzag. Wow, a zigzag.
Ending diagonal too, Peter?
Well, the zigzag, so we have basically wave A here finishing. Yeah. Right. A very small B wave, which is pretty, real time. That's pretty impossible to predict. I mean, right. you wouldn't be able to do that. I think, no, it wouldn't be obvious. You would normally be thinking such an amplitude move would be tucked into the ongoing sequence of a 5-wave pattern, which is what I thought at the time. But as it turns out, if we extend wave A by 61.8, hey presto, 41.28, we're coming into that number near, and this is wave C. So instead of actually moving up to begin intermediate wave 5, which is in terms of the secular bull uptrend, if we want to define that as beginning from the financial crisis lows. This should have developed into the beginning of a 5-wave impulse pattern, an expanding impulse pattern, but it's not. It's unfolded into a zigzag. The question is why? Why a zigzag? That doesn't make sense, unless, of course, it's part of a 5th wave, which is eventually going to unfold. I'll put this in red, as an ending diagonal. Now, that's the key issue here, and it actually resonates right through so many different indices and even commodities now that we're looking at. Because what's happened is, here we go. Here's the zigzag coming into fruition now, and of course, what we do know from diagonal patterns is that if they are ending diagonals, that is, they're either designated wave 5 or perhaps wave C of a broader zigzag pattern. That's certainly applicable to copper prices from the financial crisis lows. They should unfold, the impulse waves 1, 3, and 5, they should unfold into zigzags or multiples. By that I mean doubles or triples. Well, this is a single zigzag, fits the criteria perfectly.
Okay.
So the big,
anything like, this is the most aggressive. You've called for corrections before, but this is the most aggressive. Is it because it's an ending diagonal? And what do you think is going to be the catalyst? Yields are kind of taming down a little bit here. Everyone blamed the initial weakness in NASDAQ on rising yields. Any idea? I know you don't need to know what the catalyst would be, but I talked to you and you said you have just kind of a feeling of what's going on. Is it just, it's going to be gravity and it's just due to happen, or do you have any inkling of what could do it? Could it be a 4th wave in COVID that a lot of people think is going to happen with the UK variant becoming dominant here in the US? Could that be it?
Well, when I was a blue button trading commodities back in the late 70s, when the managing director asked me what the hell's going on and why the price was going down, if we didn't know, we'd say more sellers than buyers.
Yeah, right.
I mean,
yeah, I know.
I mean, you
don't need to know. I know you don't need to know. The reporters will tell us after, we're 20, 30.
Well, I mean, we've got to make an educational guess, haven't we? Because I mean, right. I think in earnest, it probably will be the fact that there's a bit of a whip up of fear mongering within governments. Okay. I don't know what the agenda is for these governments. I mean, that is an issue which I think merits another big discussion, because that does impact financial markets too. But my feeling is that here in Europe, they're really trying to put the trying to keep us bottled up here. And they're talking about another sort of lockdown, a 4th lockdown. I mean, we've been pretty restricted here since November, before the UK and before the US. And there's not much freedom of movement. There's been curfews at 8, 9 o'clock in the evening and so on.
Wow.
And I've seen people being
That's
stopped
when Europeans have dinner.
Well, that's right.
That's when they go out for dinner late.
That's
all
it,
right,
yeah. And it's pretty bad, really. So I don't know, we can guess that. The other thing is that I pulled up this chart, and I think this is fair to just show this one chart without copyright infringement. And it's
wow,
from Bank of America Merrill Lynch's global research their latest research, and they've basically put here an interesting chart which shows the annual global equity flows in terms of billions of dollars, and it's got $1.6 trillion. Look at this.
10 times as high as the previous.
I mean, you go back to 2002. It dwarfs it.
Nothing.
I mean, if that was an equity chart, that would be an exponential rise. The inevitable outcome of that is that all exponential rises, as you know, no exceptions, all exponential rises of that magnitude always end up with basically a parabolic, which means a collapse. And I think that the money will suddenly dry up. So whatever money is being applied at the moment to the markets, I would say there's a pretty good reason for that to dry up suddenly, and that's going to send equities tumbling down pretty hard.
Okay.
Anyway, it's a bit of background there to consider. You might say, well, why does equity start to dry up? Well, there's not an infinite amount. I mean, obviously the Fed and other fiscal stimulus programs have started to pour in money into the markets.
Boy, is that going to be a great buying opportunity should this scenario manifest. You know, you could probably have a laundry list, but, you know, I want to move on to something that is debated, and I know what some of your long-term counts, I know that you're looking for this big inflation pop, Peter.
Yeah.
And, you know, that declines in commodities at different stages should be bought up. But what do you have to say to the people that are talking about the silver market, silver ending up being worth several $100s an ounce? So you're considering this more of a inflation pop than a commodity super cycle? Because that's what's being bandied around, is that we've entered a commodity super cycle. Are you on that page?
No, not at all. I mean, the inflation pop in my book, you know, we've been talking about the inflation pop, and we coined that phrase, you know, going back, I think 2010, 2011, when we first started to see, you know, the say goodbye to the financial crisis lows, and we started to look at a sustainable run up, you know, induced by federal banks, you know, and reserve banks sort of piling quantitative easing into the monetary system. And that inflation pop came about because what we tried to do is reconcile what the stock markets, like the Dow, the long-term charts of the Dow were doing, and what commodity prices were doing. Silver's not a very good example for this. We'll come back to silver in a moment, but what I can show you is long-term copper prices. That's a pretty good example of what's going on. Now, if you remember what we showed earlier on the Dow, where the secular bull uptrend is unfolding from the financial crisis lows as a five-wave pattern, then if you take a look at, say, something like copper, well, let's take a look at the very long term. This is going back to the Great Depression lows, 1932. It's five-wave secular bull uptrend. Now, this is what I really call, a commodity super cycle, not from the financial crisis lows, but from back here. That officially ended, from an Elliott perspective at least, back in 2006 here, 2009. This is pre-financial crisis sell-off. So this five-wave advance that goes back all the way to 1932 finishes here in this period, this time period. And the correction to that, now in Elliott wave terms, what Elliott himself said is that when a correction unfolds, it'll doubly retrace. He said often you'll see double retracement. What that means is that you'll get a partial decline, then you'll get a break to higher highs and a collapse afterwards. He didn't word it as an expanding flat pattern. Perhaps if he'd had more time to bring his theories together a bit more, he would have probably recognized that his double retracement rule was an expanding flat pattern. But in principle, what he also said was that the corrections normally fall back to wave 4 preceding degree. Well, you can see that we've had 2 attempts like that here. This is really good support in the future.
Yeah.
And of course, ironically, if you extend wave A of this expanding flat pattern by 38 and 61.8%, you're going to get into these numbers. So this is our long-term collapse target, but the B wave hasn't finished yet. It's going to break into new record highs. So this is not in per se a classical super cycle in commodities, because it's part of a B wave correction. It's a bit of what we call a fake out in terms of Elliott wave. I mean, we more or less put those two words together, fake out, in terms of a B wave that gets everybody excited because it breaks into new record highs.
It's an irregular B.
It's an irregular B. It's an irregular B, yes, exactly. And then, of course, later you'll get.
It needs to, you know, you got to mix some prunes in with that copper, so it's not irregular.
Yeah, prunes will do it normally. That as much as everything else. But it will be. You will need your prunes during this decline. I can tell you, especially if you're long. But no, it's not a super cycle, so I wouldn't agree to that. But as in terms of inflation pop, we always knew that inflation was likely to start rearing its head, you know, quite some years ago, because we could sense that commodities were going to get this big push, and it was also going to be partly due to the fact that we expected the dollar to collapse.
Yeah.
Now we haven't seen a collapse yet per se. We've seen it decline obviously 2 years ago from 2017 into 2018, and then it rallied for 2 years. Now it's dropped again. Now it's rallying a bit today as well, or the last since January. But this is not what I would call collapse. That's going to come later, I think. I think once we've got a shorter term correction finishing, then that can happen. Now, in terms of copper prices, what I think is going to happen now is that we're probably going to get a drop like this over the next several months. And this is going to coincide with the declines that we've got in stock indices.
Okay. All right. All right. Okay. So, you know, you touch a little bit on the Dixie, and I'm wondering, you know, because back in 2000, when gold was trading about 200, they started calling gold, well, it doesn't work. It's an archaic relic. It's just a paperweight. And now I'm hearing the same things about VIX. The VIX is broken. I'm curious if you have any kind of chart on VIX that might have some type of roadmap for what may be this correction coming in the S&Ps. Do you chart it at all, Peter?
Well, I haven't got. I think I probably have. I don't tend to. Actually, personally, I don't.
It's
like
okay if you don't. I was just curious.
Yeah, I don't like the VIX as a timing indicator.
Okay.
It's
That's fine.
the amplitudes between that and the price action that you're actually trading. I mean, I know you can trade the VIX futures now. I mean, that's good. But I did some long-term stuff early this year as part of our. I'm just trying to find it actually. I think it's probably here somewhere. We can take a look at the long term. How about that?
Okay.
We'll just take a quick look at the long term. But UV, here we go. It should be here. Oh, volatility, UVW.
There it is.
Can you see it? Oh, yeah.
Yeah.
Okay. Let's have a quick look. Okay. Yeah. I mean,
Okay.
well, this is not real time. I don't know. What is it trading today? Do you know?
Around 18.
Okay. So about, yeah, it's dropped down a little bit lower here. Well, that's understandable if the stock indices are trading up a little bit. But I think, yeah, we're probably due for a little bit of a swing up like this. This was my idea before it starts to drop down like that.
Okay.
Anyway, that's
All
just
right. So
a very
nothing
long term.
major. Yeah. Okay.
No,
All right.
no.
Yeah, nothing major. I have one request for just a quick look at gold from Richard.
Yes. Let's take a look at gold.
And
okay.
yeah, I know you're not in the, you know, $50,000 an ounce camp or even the $5,000 an ounce camp.
No. I think that's unrealistic. I think that again, I mean, we've got. I mean, yeah, this is the very long term chart going back to 1932 again. This is a fifth wave, and a very standard, very ordinary 61.8 correlation ratio, 1 to 3 for wave 5, 61.8 of wave 5 comes in about 20. Yeah, between, I think we've got two targets, 24.55 to 28.25, something like that. It's pretty modest, I would say.
Do commodities and stocks, I mean, I'd say what really makes news is your new count on the upside of S&Ps plus this correction. Do commodities in the market kind of have the same lifespan for this rally into 2023 or so?
Absolutely, yeah. I mean, I think once the inflation pop's finished, we're going to get, you know, a bit like the scenario in the financial crisis. Once everything tops out, everything should top out within a month or two.
Okay,
and then
generational highs is what you're talking about.
Yes, I think most things, yeah.
And what's the number for your new revised upside target after the correction in the S&P? 54 what?
Oh yeah. Yes.
5,400, I believe you had up there.
Yeah, it's 5,400. Yeah, 5,405. Yeah.
5,405. Okay.
Yeah. Again, this is look. I mean, this is again repeating over and over and over the same fib price ratios. You've just got to, you know, one of the most valuable recurring patterns. You just go 1 to 3, add to 5 like that, add to 4 like that.
Okay.
That's all you do. Did it with gold on the very long term from 1932, and doing it here.
Okay.
So here, gold, I think here's also roughly what we did. I mean, as you remember, we went bearish right into this time.
Recall it.
Yeah, we had a 38% retracement. So it comes down to about 1660. But I've recently updated in our short-term bi-weekly reports. If anybody wants to subscribe to that, I'd recommend it because we do a lot of short-term work there. But the recent chart for the short-term work is a little bit of an upswing here. I'm trying to sell gold in the next day or two. If it edges up a tiny bit more, I hope I don't miss it because I see silver's already on a sell signal. But we should have one more drop down like this, maybe two. And the two downside targets, originally 1660 was here, which is a 38% extension below this level. So that's still a very important support level. But if it breaks it, I wouldn't mind betting that we actually get to 1598, which is a 61.8 extension below here. So do keep a lookout for that. The interesting thing about this is that if we get down to 1598, that will coincide with silver at 23 bucks, which is basis the gold silver ratio, which is currently trading about 69.4.
Yeah, it looks like it broke out over 68. That's gold silver ratio, but I don't want. We're close to time. I want to ask you. Sonny Gill would like to know what's your time frame for this S&P correction. When do you think? I know you do some time stuff.
For the downswing. Well, I think we're likely to see a very sharp accelerative sell-off. It will still take several months, but of course, seasonally, if we're looking for a big sell-off like that, you've got to think about October time. Oh, I'm talking about the low in October.
Okay.
Are you talking about when does the market turn down? You mean right now?
Yeah.
Well, if it turns down, it should turn down within the next week because one thing I would say is that we've already turned down in the Russell.
Okay.
Because if you take a look at the Russell, this is the Russell 2000, and there's a perfect zigzag here. A, B, and if you take 100% equality ratio between these two vertical upswings.
Yeah, you're talking about a 50% correction in Russell here.
Yeah,
and NASDAQ almost. So
yeah. You see what happens is the second wave in a diagonal is normally a 76% retracement.
Yeah. Okay.
The other thing is that we've had a sell signal yesterday because on this Russell because we've seen a 5-wave drop from the high, but look at this 3-wave correction. If you just extend this by 61.8, bang.
Yeah.
Look where it came.
Another great presentation by you, Peter. If people are asking for all these different charts, but we don't have time because we'll run into the morning edge. What's the best way for people to check out your work? You want to show your
thanks,
website?
Dale. I get a plug. Well, everybody
this is your commercial, buddy.
This is my. I'm hopeless at commercials, but if everybody's listening, this is the best report that you can ever buy. No joking aside.
Time runs out in 59 minutes. To get your you're almost out of issues because your printer's broken.
Okay. We've got a couple left. Don't you hate it when you get these things through your email box and it says last chance? If I ever see anybody say to me last chance, I just delete it because they always come back and say next to last chance. Buy here, buy that. Oh, for goodness sake, please. Look, we don't want to twist anybody's arm. We like to think that you have your own volition, your own purpose in how you're trading. Obviously, Elliott Wave is a very niche area, but it's very dynamic and it can really be of help. We're here to help you guys out there. If you want to subscribe, then we're here. You can send us emails and stuff after you subscribe, and we'll happily answer any questions. It's a real support thing, but we don't want to start force feeding anybody. I mean, it's got to be your own thing. So if you go to wavetrack.com, and you want to subscribe to our bi-weekly report, that's 2 reports per week. They're quite lengthy reports, but they're pretty good. You can view them as a PDF or online. You just go here to subscription, like this, and here's the Elliott Wave compass, and you can just basically fill it out. It's $39 a month, so it shouldn't break any arms or legs. It
shouldn't be in the market if that's an issue.
Well, that's right. I mean, really, $39. It's we're doing it really to, it should be there to facilitate everybody's budget, and we think you'll get good value out of it no matter what you're doing. We do cover a lot of US indices, but also a few in Europe and Asia, and we also cover the currencies, about 5 or 6 currencies, Bitcoin as well, if anybody's listening, and of course things like the fixed income markets and gold, silver, and crude oil. So and we
Pretty
didn't
much
discuss
everything.
crude oil today, actually. I mean, that's quite something. Crude oil.
Yeah. Yeah.
But I think crude
I
oil
know.
is on its way down as well. Yeah.
I know. Peter, thank you so much again for sharing your work with us today, and hoping all your forecasts work out, or if they become alternate counts, that you reverse out in a timely manner. And always impressed by your work, and it kind of gives me a general framework for my shorter term stuff, looking at what you get through your telescope. And you know what? Steve said you use a telescope. You're not bad with a microscope either, buddy. So anyway, thank you, Peter, very much for being here. And I'll be in touch with you to get you your next date in the rotation. Okay, buddy?
Great, Dale. Thanks very much for today, and thanks for inviting me, and say hi to everybody that knows me, and hopefully, yeah, good luck with your
Thank you
trading.
very much, Peter. It was
Great,
always a
Steve.
pleasure having you.
Lovely, Steve. Yeah, thanks to you too. Thanks a lot.
Have a wonderful rest of the day.
God bless
Steve,
you all.
Steve, you have a beautiful, magnificent, tremendous day and evening. Not just the day, the evening too, bro.
No,
So,
yeah, there's no room for cherries on top, is there?
All right, everyone, that's a wrap. Remember, don't just count your pips, count your blessings. Join Steve and the team for the Morning Edge. You guys know how to
In
find
10
Peter.
minutes. Yeah.
Yeah. Okay. And we'll see everyone tomorrow. Adios.
Bye-bye, everybody.
Cheerio. Bye-bye.